then can AO once again make the addition? To my mind, they should not, they cannot, because it should be restricted to only search action. And in many cases, as I mentioned, this issue is being dragged up to High Court, up to Supreme Court. And still, because of search, they are once again making the same addition. And tribunal has come down very heavily. In one of the recent judgments, I have not given in my note, there is Veena Developers case, the tribunal decision, very recent decision, wherein it is there on ITIT online website, wherein 80IB 10 claim was made by the assessee. It was allowed in the original proceedings, AO was not allowed. The matter went up to High Court. It is now pending in Supreme Court. High Court has given it in favor of the assessee. It is pending in Supreme Court. A search takes place. The assessing officer in the assessment order itself says that I want to keep this issue alive. Though it is pending in Supreme Court, I will once again disallow this 80IB 10 deduction. Tribunal has come down very heavily on this assessing officer. They in fact called assessing officers their commissioners in the tribunal, and they said this cannot be done. The issue is pending in Supreme Court. Where is the question of you making once again disallowance? You have not found any further evidences to substantiate your disallowance of 80IB 10. If something was found, it's a different thing. But nothing is found, and just because you want to keep issue alive, which is already alive, is already there in Supreme Court. Suppose Supreme Court decides in favor of the department, then where is the question of making this disallowance? Or take a case where it was against the assessee, and assessee was in Supreme Court. Then whether AO would have still once again made the disallowance? The answer is no, because it is in their favor. Where is the question of making once again disallowance? And therefore, such type of issues, though are very well settled, but still assessing officer makes such disallowances which should not be permitted. And one more issue is whether extrapolation is justified. This is very important because in most of the search cases, documents or evidences are found only for a limited period, either of 1 year or within 1 year of a limited months or something. Whether extrapolation is permissible, because under block assessment it was not, because there was a categorical definition of what is undisclosed income, which is absent in the new search provisions. And therefore there is a decision of Delhi High Court which has held that yes, extrapolation is justified, because if you are doing some outside books of accounts, something which you have not shown to the department, then why it should not be assumed that you are doing this since the beginning when the search proceedings have carried out. So depending upon the facts, if from facts you can prove that this type of activity, suppose it's a different activity altogether, a different business activity altogether which you started and you did not show to the department, and that activity only started 1 year back or 2 years down the line, then you can restrict that no extrapolation should be done. But otherwise, same business, same thing going on since last several years, then possibly very difficult to argue. Now coming to share premium issue, this is also, I have been told, that a very common issue taken up by AO doing assessment proceedings. Though what is happening as of now is that the AO, relying upon these amendments, want to treat these amendments as retrospective in effect and want to make such type of additions, which to my mind is not permissible, because they cannot rely upon the amendment at all, but they are prospective, they are not retrospective at all. So the question of 68, all the earlier decisions, Supreme Court in Lovely Exports, etc., and thereafter Delhi High Courts, all those decisions still hold goods until unless the amendment has come. Because after the amendment, 68 itself says that you need to prove your source of source, and that party should come forward and prove his source and all those things. So after the amendment, yes, assessing officer is very well in his jurisdiction to ask all these things. But before the amendment, he cannot proceed beyond till whatever judgments we have in our favor. Then coming to 56(7)(b), this is also very interesting. Because if share premium or share capital, anything is raised, the share premium is taken by closely held companies which is beyond their face value and beyond their fair market value, which the assessee is not able to justify. Let us say the capital of the assessee is 1 lakh, no assets are there, it's a dummy company, and then it takes share premium of crore of rupees and issues shares of 10 rupees at the rate of 1000 rupees. Where is the justification? And therefore this provision was brought into only for all this type of companies where there was no justification between their balance sheet and the amount of capital raised by way of share premiums. But this also, as I said, amendment has come later on. It is applicable only from AY 13-14. So then cannot apply these provisions retrospectively. And as per Rule 11A, this rule is also after the amendment. So this rule formula also they cannot apply to the proceedings which is going on as of date. But yes, justification they can very well ask to the assessee. And they can very well ask the ingredients of section 68 as to from whom you have received, whether you have proved the source and etc. But they cannot apply this formula and straight away make some addition in the case. So as far as share premium is concerned, the law as of date will hold good, not the amended law. With this, I thank the organizers to allow me and give me this wonderful opportunity. Thank you.
We can take few questions if we have. Under 41 months, some discounts allowed by the creditor not accounted for and credit balance have accumulated. And all of a sudden, assessing officers found financing. So whether he can add all amount, total amount in 1 year. Because it relates to each year.
Relates to each year, I understand, but in your books of accounts, you have not offered that discounts. You have not reduced your liability. Now, as on date, your liability is of 100 rupees. But because of discounts or whatever that party may have given, you may not be even aware of it, let us say. It has reduced to 50 rupees. So this balance 50 rupees is no more payable. And this is confirmed by the third party. So this is no more payable or no more receivable by us. So then that will come under 41 month.
So but it cannot be related to each year. You have to reopen each year. And
but why you should reopen each year? 41(1) provision is where the liability ceased to exist. In the year in which the liability, according to your books, the liability has ceased to exist in this year. Why you should go and reopen for your earlier 4-5 years? You pay tax in only 1 year.
How to prove the year of cessation of liability?
In the year, in the case when it is not written off.
That's what I said, this Bombay Tribunal along those decisions, they said that if it is long period of duration have passed, you are not able to bring forward your creditors, you are not able to prove that the liability actually exists as on date, there is no confirmation from third party or the third party is not available at all, then now where is the intention to pay? There is no intention to pay at all. And if the AO has made the addition, then it will be proper.
Year of taxability.
That's what I'm saying. It is for the management to decide actually. The management should write off all these liabilities which are no more in existence. But they don't do it. They don't want to offer it to income because tax is to be paid. So they don't do it. If they don't do it and drag along year after year, then when AO will do it.
So the year in which AO does, that is the probability.
Because even if you challenge, what you will challenge? Supposing before
Discussion is exactly on that. Calendar year of taxability.
that only, because suppose you yourself have thereafter in your profit and loss account, let us say the scrutiny assessment proceedings were not taken up or were taken up but this issue was not there, and before taking this issue for next year you file your return wherein you have shown this as 41(1) income and paid the tax, then of course there is no question of taxing you once again. So all this depends on the intention. Or suppose you made some payment to that party and that party also confirms that yes, this is in existence. So even if 10-15 years have passed, still it will not be added because something is there to prove.
Sir, regarding partnership problem, the heavy credit balance of the partners are there and they are earning interest as well as remuneration and profit, tax profit. So what extent this is also in that case?
Under 14A,
Yeah.
depends on what expenditure the partner is claiming.
Against interest.
So that's what I'm saying, against interest right. So proportionately it has to be disallowed because he is earning tax-free income.
No, my point is that sufficient credit balance in the partner's account are there. Further addition of capital is brought in the company partnership, and on that capital which is brought out from outside, on that he pays the interest and he earns interest here.
Right, he is earning interest, but at the same time is also earning tax-free income.
But is it from own capital in opening?
But is it the business only from the opening capital? Is it the profit of the business only from opening capital? Then why the capital was required at the first time?
There are two things.
See, the AO will not go by that. Because AO will say you have brought, suppose the partnership firm would have brought the same capital. Then it would have been a different thing. Then it was a different thing. But partner is bringing in additional funds, it is giving to the partnership firm, and partnership firm, those funds have utilized for business purposes, which has generated profits.
But there is a situation change. Previously the creditors was to be paid after 45 days. Now the creditors to be paid within 15 days and the debtors to be recovered after 2 months. There are the situation where the fund is required and has come to the company. Where is the question of raising the fund for any other?
Can you prove the nexus?
Yes.
If you can prove the nexus that what funds were brought in by the partner has directly gone to the payment of creditor and not a single rupee is utilized for your day-to-day business activity, then perhaps you may have a good case to argue.
Yeah, maybe it's a payment for bank, it's a payment, it's a generated business.
But then if you are using it for your normal business activities, then from that you are generating business profits. Business profits are also generated from there.
Sir, in a group of companies, if it is builder and developer, they are utilizing their surplus fund in other companies. Can you write to say that interest earned by you is other sources income and your expenditure towards interest is your business expenditure?
He can do it. Because you are not in the business of banking, lending. Your business is a builder and developer. Ideal surplus funds are kept with you, so you have invested. Even if you had invested outside, what would be the fate? Same fate. Just because you have invested with your own sister concerns doesn't become your business income. But nexus, you will get the set off.
The same fund is transferred.
If you are able to prove the nexus,
Yeah.
that interest, expenditure and interest earned. If some such type of situation is there, then nexus is for the netting you will get.
In case of bogus purchase, can it be claimed that sales tax department is not saying that there is no purchase, they are saying that they have not paid the VAT, so purchaser has to pay the VAT. They are accepting that purchase is there. So can we say that the department saying that there is no purchase is wrong because sales tax department itself is claiming or collecting VAT on that particular purchase?
No, I understand what you are trying to say, but that VAT what they are collecting is because you have claimed a set off. So that set off is not allowed to you because that party has not paid the VAT.
In case of 41(1), in case of capital expenditure, cessation of liability is also for capital expenditure liability. What will be disallowed? Will it be only to the extent of depreciation, which I have claimed till date?
That cannot be, I don't think that there will be any addition. There is a Bombay High Court judgment, I think, Mahindra and Mahindra.
And similarly, in case of a Hawala transaction, say, like the purchases were already disallowed earlier, then can there be a subsequent addition again? No. In case of 41,
Sir, if purchase is from a Hawala dealer and then the assessee has offered it to income as under section 41 in later years. A purchase is from a Hawala dealer and then the assessee has written off his balances in later years. So will it have any effect on the reassessment proceedings?
See, reassessment proceedings, AO will say that this is not a genuine purchase, so he will disallow in that year.
Okay.
You can argue for double taxation. You can tell that it is becoming a double taxation event. But the year of taxability will be the year of purchase. So if he has a time limit, he will disallow in that year. Maybe then you may have to file 154 or some 264 repos or something where in the year where you have offered this amount. But otherwise you can always take this ground that you already disallowed. But 99% AO will do the reassessment and disallow in the year of purchase.
The financing officer has issued 148 in the name of a partner instead of firm. We have submitted the detail that this all the bogus purchases related to the firm, so it should be added in the firm's income. But at the same time, he has gone through the details of the partner where he has found cash deposits. Since the 148 doesn't stand, can he make the assessment by making all these additions?
No. 148, it was issued, reason was only for the Hawala purchase.
Yes.
Now Hawala purchase is out of question for the partner.
Correct.
So he cannot go ahead and make any other addition. The provision is now very clear.
The 41(1), now he tried to say that whether it was a trading liability or whether it was liability from some capital asset. So many years have passed, say 5, 10, 15 years have passed. Then the onus is on whom to prove that whether it was trading liability, was existing in my balance sheet. Whether there was some trading debit or whether it was some other reason.
See, first assessee should prove that this was never debited to my profit and loss account.
It will not be the department's onus to say that there was some debit in the past year.
I understand, but he is going by 41(1). He will say that, okay, I understand onus is also on the AO, but it is always better that assessee proves. Because tomorrow question will be passed to assessee that you show whether you have debited this to your profit and loss account or not. Because if you have not debited, then it is a good case for you to simply argue. Because neither if the AO can do it, neither the assessee can do it, and it is a trading liability. Then who will say the facts? Very difficult. The facts only assessee can establish. Advances for trading, is it for trading liability? If it is for trading liability, yes. If it is not for trading liability, then no.
I think so. We have done with the questions. I will request Siddharth to give a hearty vote of thanks to our speaker.
Thank you, Chamber. Thank you, seniors. Thank you, speaker. When today I came here, I was thinking that मुझे lunch तो आज करने ही नहीं मिलेगा. I'll ask Kripal by many questions, but after hearing this session, I'm sure कि I'll take my lunch peacefully. I don't know about Kripal sir. Okay, today he covered many topics like suspicious dealers, section 14A to 22E, cessation of liabilities, search assessments. What he actually gave was more important, not theory, but actually practical, what layout actually is going on there. Don't commit your liability. Just prove yourself that what evidences you have. He also covered settlement commission suspicious dealer. He said there are no further investment by department. So beyond prove your stand. In section 14A, he explained basics, gave practical tips, what he would do, and what actually he would do does is he does not go to section 14A, he goes to rule 8D. Then 222, he said that 222 DDT should be removed. It is his opinion, and I also appreciate that. And I think many doubts are cleared by him. Thank you, sir. Please give him a big round of applause. And please start with your lunch. Please come on there. Thank you. Try to reassemble by 2:30.
You don't know anything about it.